This is Pam Miller of our staff. Pam is a financial analyst. She's an accountant and an attorney, but she acts as a financial analyst for us. Mark O'Brien with Raymond James out of Dallas. He's our underwriter on our bond issues. But he is from Oklahoma. He is from Oklahoma City, and he is a recovering bond lawyer.
First step is admitting you have a problem.
Yeah, that's right. You got 11 more steps to go. And Sujo Patel is a bond attorney, works on all of our bond deals. He is with the Peck Schaefer division of Dinsmore Shoal law firm in Cincinnati, Ohio. Even though Sujo is not from here, we have adopted him as an Oklahoman now. So welcome to you guys for joining us today. I think you received 3 pieces of paper when you came in, an agenda, and also a PowerPoint and a handout. The Internal Revenue Code has a provision that says that if you finance 50% or more of your development costs in a multifamily construction project with tax-exempt bonds that come out of the state private activity bond cap, then you are entitled to a 4% tax credit. Now, granted, it's not a 9% credit, but nonetheless, it is a credit that is unlimited in amount. It comes into the state from outside, and it wouldn't ordinarily be here. So it's not competitive. And so it's a great financing tool. We have not used it a lot in Oklahoma. A lot of other states are way ahead of us. So the purpose of this seminar is to introduce you to this financing concept, which is really an alternative to financing just with the 9% tax credits. Now, lest you think that this is something new that's been dreamed up by us or whatever, it's not. It's very legitimate. Like I said, it's been used excuse me, in a lot of other states, but it's just now really being done in Oklahoma. To date, we have 8 finished or under construction projects that's financed with bonds and 4% credits. We have 3 where the funding is in progress. We have 3 applications submitted and pending review, and we have 9 that we're working on. So we're gaining some momentum. We're gaining some traction. So what we're going to do is we're going to follow the agenda today. We're going to go down and we're going to start by talking about the basics. Then we're going to talk about the parties to a transaction, review a couple of different structures, talk about the timing, visit about the costs, and then talk about our application process. So we're going to take questions as we go along. We're going to try to save a little bit of time at the end for additional questions. But if you have questions as we're going along, please raise your hand. So with all that said, Sujo is going to lead off and talk to us about some of the basics, some of the 101.
So the first, and I'm going to loosely follow this PowerPoint. The PowerPoints obviously are yours to take home, so you can spend more time with it. And at the back of the whole presentation are numbers for everybody that's up here, including one of my other colleagues at Dinsmore that has quite a bit of experience representing developers in 9% transactions. And so a lot of those same issues come with 4%. So if you ever have any sort of in-depth questions about numbers and basis and all the kind of stuff that just an old bond lawyer would not know about, you can call Luis Diaz. But the first question is, what is a bond? And really, a bond is just a note. It's just a way of borrowing. And it's just like when you go to the bank and you borrow money. Let's say for your mortgage, you sign a promissory note or a promise to repay. And a bond is really just that. The OHFA issues bonds, and to the market, to the general market, and then uses those proceeds to pay, in this case, for affordable housing. This is the primary way that governments borrow for their purposes, whether it's their traditional governmental purposes, building public buildings, streets, sewers, those kinds of things, or whether they are conduit transactions like what we talk about where a government borrows on behalf of a private entity. Bonds, just like your own mortgages, can come in many different flavors, fixed rate, variable rate, long-term, short-term. They're really no more complicated than that. As I was saying that, you have two types of bonds. You have government bonds and you have conduit bonds. Government bonds are bonds that primarily we don't talk about with OHFA. Although, I guess if OHFA ever issued a bond to build their building, then that would be a governmental bond. But in most instances, what we're talking about here for today's purposes is OHFA acting as a conduit issuer. So what the federal government permits the OHFA to do is to go out in the market, issue bonds on a tax-exempt basis, and then turn around and loan the proceeds to all of you for affordable housing purposes. And I don't think we need to get into the rest of that. The primary advantage, the reason why this program has historically been successful, and Mark will probably talk a little bit about why, sort of the dynamics we've been playing with since 2007. But historically, the reason is that if OHFA issues bonds that are tax exempt, then basically that lowers the cost of borrowing. So instead of going to your bank and getting an 8% mortgage for your affordable housing transaction, OHFA might be able to access the markets at 5%. We talk about the all-in borrowing rate and some numbers here in terms of what advantages that it is. But I think that the real issue is that lower rate line, which is that if you have a lower rate, you get either more loan proceeds or you can generate more project cash flow. And that's really the primary purpose for long-term tax-exempt financing. The other huge benefit, and I'll take a little pause here, historically, the tax-exempt markets have had a very favorable relationship to taxable markets, right? You borrow at 8% on the taxable markets. On the tax-exempt markets, investors are willing to pay you 5% because of their yield might be the equivalent of 8%. So that's been historically the relationship between the taxable and tax-exempt markets. Since 2007, 2008, that relationship has really gone wacky. Actually, I once told an investment banker friend of mine that I made some comment that the financial markets or the relationship to taxable markets is not right or is incorrect or something like that, and he reminded me that the markets are actually perfectly right. They're working exactly the way that they're supposed to work, and we are right now in a situation, although we may have come out of it just recently, where you have an inverted yield curve. And so basically, you're not able to, for a whole host of reasons, since 2007, on a long-term basis, you're not really able to borrow at rates that would give you a competitive advantage over taxable financing. But the reason why our world continues to issue tax-exempt bonds for housing purposes is because one of the advantages that you get with tax-exempt housing bonds is you get access to 4% tax credits. And that's what Daryl was talking about earlier. You got your 9% tax credits and you got your 4% tax credits. As a general matter, the 4% tax credit allocation will raise about half of the equity that a 9% transaction would raise. My partner Luis Diaz talks about when you do a 4% transaction, you're drinking beer, really good beer, but when you do a 9% transaction, you're drinking champagne. But it's still attractive. I mean, right now, you all know this. It's very difficult. It's very difficult to get affordable housing transactions to work, to finance your affordable housing projects. And so this is where the 4%, equity, while it may not be the equivalent of the 9%, the question is, can you get your transaction to work with 4% equity? When you issue tax-exempt housing bonds, then let's back up. 9% equity, the reason, one of the issues that we have with 9% equity is that it's capped. There's only a certain amount of 9% low-income housing tax credit that the agency can allocate in the entire state. There is no direct cap on 4% credits. The cap sort of works in an indirect way by limiting the amount of tax-exempt bonds that you can issue. But since 2006, I don't think that any state in the United States has actually, used their annual allocation of volume cap for bonds. So we've just not seen that. We certainly haven't seen that here in Oklahoma, where we have been rolling forward volume cap every year. So the 4% allocation is not, there's no direct cap on it like a 9%. So for all intents and purposes, right now, if your project works, if you can get an allocation of bonds, and we'll talk more about that later, you are eligible for an allocation of 4% tax credits. Pam has instructed each and every one of us, and Daryl, you didn't do this, but she has instructed each and every one of us when we're up here to say that the 4% credits are not automatic. You don't just get them by showing up. And she's right. And that's true, by the way, in every state. The way that the tax credit process works, and most of you are more familiar with this on the 9%, is you have to go through the agency's underwriting rules and policies and procedures, and those are commonly known as a QAP, the Qualified Allocation Plan. They do it every year. It's subject to public comment. Many of you appear and make comments, and then you go. Some are accepted, some aren't. I see some laughing out there. But and then you go on and you put your transaction together and you try to get this allocation of 9% credits. Well, many of those policies, goals, procedures, and underwriting provisions are applicable to 4% credits. And that's that's pretty much in every state. No, it's not competitive, so that's a good thing. But you still have to meet the various other rules that are required. So they're not automatic, but you are certainly eligible for them. And if you can meet the underwriting criteria of the agency, then you can get an allocation of credits. What do you have to do? One of the things that you have to do, though, is your bond issue has to finance, as a general proposition, 50% of your project costs. It's the more technical requirement is up there under. Well, it's actually under the state tax credit ceiling. But if 50% or more of your aggregate basis in the building and the land is financed with tax-exempt bonds, then you are eligible for 4% tax credits. The state tax credit, and I will apologize, I did not, and Pam may know this, Pam or Daryl, I did not look at Oklahoma's new state tax credit provisions. As a general matter, in most states that have state tax credits, if you meet the same rules for the 4% federal tax credits, you get an allocation of state tax credits as well. Different states differ on that, and Oklahoma is a new one.
As many of you know, the state credits have to equal the federal credit amount, and you have to request it. And the 3 counties of Tulsa, Oklahoma, Cleveland are not eligible for state credits. And with our 4% deals, we recently opened up $1.5 million in state credits to be used with 4% new construction bonds, and that's already been, we already have excess of that requested, so I don't think we have to worry about using that. I think we're okay on that, but we'd like to see more of it go into the 4%, but it's a good resource for the 9% as well. So that's just kind of where we are right now.
Putting these transactions together for you guys is very complicated because you're not going to get a single source of funding to pay for your entire project costs, pay for all your project costs. So you're putting together federal tax credits. If you're eligible and you can get state tax credits, you're putting together state tax credits. If there are home funds available for your transaction, you're getting home funds. There's also historic tax credits, both federal and state historic tax credits. And each of these have their different rules and compliance procedures. And it is difficult. At the end of the day, I think that if you can get through it, it is worth it. There's some fabulous facilities that are being financed, but it's not easy these days. It used to be a time when you could get all of your funding with just tax-exempt. In fact, when I started this, from '91 until probably the mid '90s, maybe '96, I had never done a tax credit deal. I mean, I was doing hundreds of multifamily bond transactions throughout the United States, and not one of those involved tax credits. Starting in '96, we started seeing more and more, and that's, you know, it was enacted, I think, in the early '90s, something like that. But starting in '96 is when we really started to see that market develop. And today, you know, I think maybe 5% of the deals that I do don't involve tax credits. And those are really 501c3 transactions, which is a completely different animal. So, so you have to cobble together all of these different funding sources, and you know that's where Oklahoma Housing Finance Agency can be a huge asset. I mean, they have a lot of experience. They understand what's going on in the states. They can help determining what is available. They just did a transaction. Was it called New Page? Yeah, we just did a transaction called New Page that, you know, Daryl and Pam can or Mark can talk about later. I mean, it was probably one of the most complicated transactions I've ever seen, and a lot of experience gained by all of us sitting up here in that transaction.
Old original Douglas High School here in Oklahoma City, which is right south of the Health Sciences Center. It's currently under construction. I encourage you to go by, take a look at it. It's a massive project.
State tax credit, federally, 4% loan, housing tax credit, and federal historic tax credit, state historic tax credit, there's Freddie Mac, that's financing. A lot of layers of financing.
It was in a TIF district.
Yeah, it's a wonderful project for Oklahoma City.
And it's going to transform, I think, that whole area, that whole corner of Oklahoma City. So really, one of the things I want you to take away from this is that, you know, in order to get the 4% tax credits, at least generally 50% of your project has to be financed with bond proceeds. And Mark is going to get into a structure that we use almost exclusively today to finance affordable housing, and because one of the questions that you'll ask is, well, why 50%? Why not 100%? Which, you know, which would be the goal, and that has to do with the fact that we're still not in an area, we're still not in an economic environment where long-term tax-exempt bonds work. So we've created this short-term tax-exempt structure that Mark will go through, and this is a key part of it. You're issuing bonds only to access these 4% housing tax credits. So the federal government does not like to forego tax revenues. I mean, they do it very grudgingly, and that's why we have some of the limits that we have in terms of the 9% tax credit cap, in terms of the indirect cap on the amount of private activity bonds or these conduit bonds that the agency can issue. And so when you get to into the housing world, basically, this is what I call the quid pro quo page. There's a quid pro quo. Many of you have already done 9% deals, so you already understand this aspect of it. But for those that you haven't, there are limits on what you can do with the bond proceeds, and there are limits on who what your tenants look like, and there are limits on what your project looks like. So generally, 95% of the bond proceeds that are issued have to be used for qualified costs. Some portion of that can be for land, but it's primarily, majority of that is for depreciable property. Well, there's the next rule. Not more than 25% of it can be allocated to land. Usually that's just not an issue. The only time that you have an issue like that is on both coasts, the East Coast and the West Coast, where land costs are really high. And then you have it in some of the areas like, for example, Denver. Some of the ski areas, the land costs are astronomical. And so, you know, affordable housing, unless you can find a different way, doesn't work because of this limitation. As a general rule, and this is just a bond requirement, 15%, you have a requirement that you must expend 15% of your proceeds on rehab for an acquisition financing. So you have two flavors of transactions. You have a new construction transaction, and then you have an acquisition rehab transaction. And the reason for the 15% rehab is that, again, the government, the federal Congress, you know, a long time ago, didn't want you to finance used items. The easiest way to understand, we have this other type of transactions that are called IDBs, which are industrial development bonds, and those are for factories and things like that, factories, manufacturing facilities, those sorts of things. And so this concept actually came from there, where they did not want to see somebody issue bonds to either refinance for the first time, to either refinance or to buy used equipment. So they said, well, we'll make you spend a certain amount of money, and then that used equipment will become new equipment. And that's kind of the approach that they've taken for housing. I think we all know that 15%, I mean, you can't take an old tired property and put 15% into it and turn it into new property. But this was written a long time ago, and it's really irrelevant. I'll tell you, and the reason is because you're going to go for 4% tax credits. You wouldn't do a bond issue without 4% credits these days, unless you were C3, and then the C3 gets a buy on the rehab requirement. So you're doing this to access 4% credits. Well, your tax credit syndicators, and have negotiated this before, it doesn't matter what your PCNA says, for the large part. They want you, their goal is to get you to put as many dollars per unit into that project as you can to renovate that project. And the numbers range anywhere from $25,000 on up to $35,000. I mean, we've seen instances where a new roof was put on a facility 5 years before the financing, and the tax credit investor came in and said, "No, we need a new roof." I don't mean to denigrate the tax credit investor's position. I mean, their position is that they've got to be absolutely sure that this project is a perfect project for 15 years. Otherwise, their tax credits are in jeopardy. And in a way, you could say that they're kind of looking out for you, because if their tax credits are in jeopardy, all of you guys that are doing these deals, the guarantees that you sign or that you put up. And so, you're guaranteeing those tax credits. So they basically want you to take this acquisition and turn it basically into a new building. And for those of you that have seen this, I mean, the transformation is absolutely amazing. You see this project before that was operating as a good, affordable housing transaction, and then you see it afterwards, and you're just like, wow, I mean, I would live there. So this 15% rehab requirement really is not really applicable, but it's one of the things that people like me need to check off our list to make sure that you're doing that so that you're eligible for these bonds. We'll talk a little bit later on about, every state, in addition to what the tax credit syndicator has, every state also has their minimum threshold requirements for unit rehab. I have yet to work in a state, including Oklahoma, where the State Housing Finance Agency's threshold unit requirements is more than what the tax credit syndicator will require you to put in. Now, if you happen to run into a situation, whether it's in Oklahoma or any other state, I think it's reasonable. If you happen to run into a situation where your tax credit investor says, we're only going to require you to put $22,000 per unit in, on average, and the state has a higher requirement, then I think it's worth going in and talking to the agency. I've never seen an agency that's not willing to sit down and talk with you about it. But it usually just doesn't happen because the syndicators require a lot more per unit. The next is a 2% cost of issuance limitation. These days, that really doesn't come into play. Basically, you can't use more than 2% of your bond proceeds to pay for cost of issuance. Usually we're using equity or some other source to pay for cost of issuance these days.
Sorry.
I think the laugh was probably because the cost of issuance typically exceed 2% of the bond amount these days.
You found a good workaround.
Yeah, we found a workaround. The fact is, as I was saying before, these bond issues, they become very complicated. And the number of specialists it takes, whether you agree with it or don't agree with it, the number of specialists that it takes to, like for example on that New Page transaction, you had to have folks that were familiar with bonds. And not just familiar with bonds, but those folks had to be familiar, at least in terms of terminology and broad concepts, with the local housing tax credits, state housing tax credits, and the TIF rules. Why? Because every aspect of this has compliance, what you can use their proceeds for and what you can't. And so in order for me to do my job, I can't just simply say we can't use bond proceeds for that. I've got to try to work with those rules and try to figure out how we can allocate these. And I'll tell you, we even on that new page deal, we've done some, allocation of bond proceeds or allocation of other funds to costs, where the costs were expended and paid before those other funds came in. And what we do is we rely on reallocations that are done 18 months after the bond issue has been issued. And so you've got me on this side trying to do it, work with the others, and then you've got all of those experts sort of working in the same way. And it's just, it's become very complicated. But, we can get them to work, but you take a look sometimes at the cost of issuance and you just kind of scratch your head, especially when you compare it to your developer's fees or, other costs. But there you go. The average maturity of the tax-exempt bonds can't exceed 120% of the average economic life of your project. We've never had an issue here, but basically what the government is saying is we don't want you to issue bonds that have no relationship to how long the asset is going to be around or viable. Reimbursements is probably one of the important things here, and Pam and Daryl do a great job about this. Many of the expenditures, many of the things that you're going to pay for before you pay for, not incur, but actually pay for, before you get to the bond issue, you can pay those back with bond proceeds. So let's say if you pay for a survey, okay, and you're paying out of your pocket for that survey, later on when we issue bonds, some of those proceeds can be available to reimburse you for the survey that you paid for. There are other costs that are not preliminary in nature. One of the things that we've been sort of dealing with right now is that, my developer friends tell me that it's really a seller's market out there in many markets. And so your contingencies have gone away. And so if you want that transaction and you want that deal, you're going to have to find a way to take down that deal within the confines of when the rest of your transaction can be put together. Many transactions use FHA insurance. The FHA insurance process is god-awful long. I mean, it just does not meet the needs of developers today. So if you're fortunate enough to be able to access a warehouse line or even pay for it out of pocket to take down a facility, that is not a preliminary expenditure. And before you do that, you want to go into OHFA and get them to pass what's called an inducement resolution. And then there'll be different rules with that, but the key takeaway is if you decide you're going to spend more than just the customary preliminary architect, survey, the third-party reports, then you want to go in, you want to talk to Daryl or Pam, and you want to talk about getting an inducement resolution. The good news is that the agency has recently made changes to their process. So getting an inducement resolution is actually much easier today than it was, in the past. And that's, OHFA sort of accommodating or understanding this dynamic that's out there in the market. So that's a real takeaway from these rules. It's the reimbursement. If you're going to do anything more than just preliminary expenditures in nature, go ahead and get an inducement. Yes, sir.
I'll be back on the rehab deal.
Okay.
Let me explain my situation. In 15 years, my agreement with the syndicator is that I have the option to meet any best offer because they want that property sold. And I was looking to the 4% to help me with acquisition costs. But the OHFA new construction rehab doesn't kick in for 20 years where you don't get points for it for 20 years, so until the property is 20 years old. So I got that 5-year period between acquisition and the time I can do new construction rehab on it. Can I use the 4% simply for acquisition and if I use 15% for rehab, or do I have to meet that 20,000 per unit threshold for rehab?
Well, so there's two things going on here. The 15% is just bonds.
Right.
That's going to apply for any bond issue.
And I'm hoping to use that, tap that also for acquisition. Buy
But-
my own property in 15 years.
So you're talking about a restructuring?
The way the contracts read with the syndicators is, I have the right of first refusal. So we put the property up for sale. And if an offer comes in where I think, well, funding source to acquire that
Yeah.
project.
So you're at the end of your initial 15-year compliance period, and by the way, I mean this question is more suited to my partner, but I'll try to answer it without screwing it up, and I'll get some help from Daryl and Pam. But you're at your end of your 15-year compliance period, and you're looking, and your tax credit investor, of course, wants to get out, right? So you're looking for a way to, another way to say it is recapitalize the transaction and to take them out. Yes, we can do that. Now, well,
4% and above.
sure.
And there's no 20% or $20,000 per unit rehab requirement.
No, let's say you're in your, and let's say your first one was a 9% transaction.
Bert, your seats are-
Hey, Bert.
Sorry. Sorry,
How are you guys?
How are you? Good seeing you, sir. We've got Bert Belanger and Bob Nance in the audience, and they are OHFA's Issuers Council.
They're the guys that
General-
get me out of trouble. Tried to.
And I'm late. What's that thing?
Yeah, they're the guys when I say, hey, we'd like to do this in a bond structure, and Bert and Bob will say either yes or no. We're not going to do that. Because even though the issuer is a conduit issuer, the fact is they're just a conduit to you accessing these various products. And they don't want to be, they're not a partner in that sense, and they don't want to be put in any position of loss or liability or anything like that. So that's where these two guys come in. They play a very important role. So let's assume that your initial transaction was a 9% transaction. All right, so you followed all the rules, you did all the unit rehab requirements that were required, and let's say it was new construction, make it even easier, right? So you place it into service, and now you're at the end of your 15-year compliance period. Tax credit investor within your LPA has an exit strategy, okay? And as a part of that exit strategy, just to simplify it, they're saying, in year 14, you have to put this thing on the market, and you can sell it in year 15. And during that period of time, we'll give you the first right of refusal. Okay, you can't, they're not going to permit you to sell it within the 15 years because that raises a whole bunch of other issues. In fact, they would permit you to do it, but the buyer would not come in and make all the guarantees that would be needed. But so you get out of your compliance period, and you'll have to work with OHFA because there's an extended use agreement in place and whatnot. When you come in, basically what you're doing is you're reforming a partnership. You're creating a new partnership. That new partnership will now go through OHFA's process for both bonds and tax credits. And yes, when that new partnership, assuming that you're going to do bonds with 4% tax credits, your tax credit syndicator is going to come in, and they're going to have their requirements for how much unit rehab needs to occur. And and we're just now seeing a whole bunch of these, right?
But that would way exceed the 4% amount. I mean, 20,000 per unit, plus taking out the loan and making it financially feasible. There's no way that 4% would finance half of that transaction.
No, it wouldn't finance for half of it, but what you're
30% federal need for 4% extra in capital stack.
Well, I see obviously something I'll have to take it.
yeah, and these transactions work, but the bonds that you're issuing, the 50% you're talking about, that's not intended to pay off your entire debt. You're issuing just the amount of bonds that you need to get the tax credits. What you've got going on simultaneously that Mark will talk about is you're going through an FHA insurance or some other process where you're going to get a long-term loan. That long-term loan will do two things. It'll pay off your bonds, which are viewed as construction bonds, and it'll pay off the remainder of your long-term debt. So, you're basically refinancing what's left of your original transaction plus some. But we'd be happy to, go through numbers with anybody for transactions that you have to kind of, and we can produce, and Mark has brought some numbers with him from a transaction, which may not be as helpful to your transaction, but we can do sort of talk one-on-one about how to get the transaction to work. But they do work. There's some that aren't going to work, but I can't give you the percentage, but we can get them to work. the last thing is you're going to have a bunch of arbitrage provisions, and they're so technical that I just let my tax partners deal with all of them. But the takeaway is you can't borrow too much, too soon, for too long, or for a bad purpose. That's basically what when somebody says arbitrage, that's what it gets to.
On that slide, you've got a 60-day look back on anything prior to your inducement. If I get an inducement bad costs incurred prior to the inducement, I can go 60 days back.
Yes.
It's not from date of inducement.
It's from date of inducement.
I'm sorry, but it's not. There's 60 days prior to that where I could have costs.
Yes.
Also.
And
And that's right. Okay.
right. And it's not just incurred. If you have costs that are incurred, but you haven't paid for them,
Right.
you don't have an issue.
Okay.
If you have costs that are incurred and you've paid for them, then you can look back 60 days prior to the inducement resolution.
Because this is a reimbursement.
Exactly.
Right. If I have
Because it's a
reimbursement.
reimbursement. Then it's not a reimbursement. Exactly. Perfect.
Okay.
And the other thing to keep in mind is, and I don't really go through it here, but that's for not the typical preliminary expenditures. So one of the things that we're going to talk about is that I think most of the people in this room raise their hands in experience with 9% tax credits, right? You put your 9% application together and you submit it. And I don't know what the success ratio in Oklahoma is at OHFA, the other OHFA, Ohio Housing Finance Agency. You know, a developer has maybe one in 6 chances.
That's what it is here.
Okay,
For all
so
states that start with O, it's 1 in 6.
for all states start with an O. Right. And so if you don't get if you're not successful in your application, you may be able to, you may have the option with respect to that land or property for another year so that you can put it in the following year, right? You know, most developers, on average, for a particular project, they'll make 2 submissions. After 2 submissions, either they're successful or they just drop it, right? You all know what you've spent. All right, now those are preliminary expenditures, unless you take down the property. Those are preliminary expenditures, and you don't have to worry about the 60-day. If you don't know, give one of us a call and we can tell you. But one of the things that I want you guys to keep in mind is because those don't have a 60-day requirement, and let's say $40,000 is what you've paid up until that point, including 2 submissions. You know, that $40,000 is going down the drain. The question for you is whether you can restructure your transaction to work with 4% equity. Many transactions can be. It's not going to be the original. It's the whole champagne versus beer. Instead of marble countertops, you may have Corian countertops, which, by the way, was one of the things in Ohio. A developer was putting in marble. And he was doing it from his purpose. He was doing it because it had the longest life. Now, I'm not sure I agree with that, but that was his perspective, and that was his 9%. And the other thing he had was, you know, he had attached garage. This was a single family, a portfolio of single family that was being done as rental. So he had attached garages. So basically what he was able to do is restructure his transaction. He put in different kind of countertops. He put in made a few other changes, including making more common garage, a shelter or just a roof instead of enclosed garages and attached garages. And he was able to get his transaction to work as a 4% transaction. So that's important for 2 reasons. First of all, I mean, you know, before you give up on it, let's see if you can restructure it and get it in as a bond 4%. But more importantly, you don't have to worry about many of those preliminary expenditures. You have to worry about this inducement issue. The next things are occupancy rules. I think most of you are familiar with this, but you know, the bond rules are you have to set aside 20% of your units for people at or below 50% area median income, or 40% of your units for people at or below 60% of your median income. Most of you have experience with low-income housing tax credits. You're going to have all of your units subject to affordability requirements so you can generate the most equity. So that you can have as many tax credit units. But that's just simply for bonds. And the rest of the rules kind of line up with what the tax credit rules are also.
Yeah, but for your bond deal and your 4% tax credit, you should just choose 40 at 60 and make all your units at 60%. Because you don't have to do that lower income targeting for points. I mean, you certainly can, it's part of your mission and part of your service, but for financing, it's best if you just make them all 60%.
Daryl, is this, I think, when it's my turn to stop talking, will you let me know?
No, you're fine with this
Okay.
slide, and then
It's the next one.
your next deal is going to be
Okay.
very quickly go through the parties.
Yeah, I think that's,
Yeah,
is that Mark?
that's you.
Oh, okay.
That's you. And then-
That's me.
And then Mark.
All right. So as a general rule, these 4 bullet points right here sort of generally talk about the process for getting bonds issued and therefore tax credits allocated. You have to make sure you have enough volume cap. That's not an issue. We'll take care of that up here. You have to get an inducement resolution and approving resolution from OHFA. Their rules are very clear and laid out. I apologize, I'm fighting a cold. The rules are laid out on their website, in their policies, and in their guidance. Otherwise, you can just give Pam and Daryl a call. There's a public notice requirement. This public notice requirement, keep in mind there's 2 kinds of public notice requirements. One is for the bond side. We take care of that. But there are also, I think in your QAP, you have public notice requirements. And do you have templates in your?
For the public notice, yes. Yeah.
The only public notice for 2017 that developers have to do is the publication notice. We took out the written notice, remember?
Okay.
We're doing that. And then the bond stuff, like you said,
We'll talk about the typical participants in a bond deal, and I'm going to quickly go through this. The real reason I'm going to do this is because it's going to give you a little bit of context for when Mark sort of talks, plus to kind of let you know our glossary. It used to be that one of my partners before it got really complicated, one of my partners used to say anybody could do bond work. Any lawyer could do bond work. You just protected your glossary. You didn't let other lawyers have your glossary of terms, because then they could do it as well. And so this is partly the glossary of terms. Obviously, you got an owner. When we talk about an owner, we sometimes interchangeably use owner, borrower, and developer. Yes, they're kind of 3 different things, but we generally describe that as the person or the entity that's going to build, operate, and own that facility. Sometimes we have a 501c3 entity. If anybody's interested in 501c3 transactions, if there's nonprofits here, we can talk about that later. You have an issuer. In this case, it's Oklahoma Housing Finance Agency. There are other issuers that are available in the state. There's
for 2017,
Yeah.
we're requiring us.
Yeah, we changed that.
for the tax credits.
In order to get the
In order-
4%
okay.
tax credit, we have to be the bond issuer.
And I got to tell you, I think that is, in the vast majority of states that I work in, you have state housing finance agencies they're the only allocator of tax credits. And in the majority of those states, other municipalities in that state can issue bonds. So you could go to one municipality for bonds and then go to the state housing finance agency for an allocation of tax credits. And by and large, that's just not efficient for the borrower. Not only that, but state housing finance agencies like OHFA, they have a process in place. And often, folks might complain, including bond counsel, might complain about the rigid nature of the process. But the fact is, there's no surprises. It's right there. It's laid out for you. You go to some local issuer, and you never know when you're going to run into NIMBY issues. You never know when you're going to run into other political issues. You don't know if that small local issuer is going to be meeting regularly or if they cancel meetings. So the good news is that you've got OHFA here that is very willing to work with you, and I think that any cost savings that may be apparent in some of these transactions are eaten up by the inefficiency of going to 2 different places. So in this case, they've made it easier for you, but the issuer in this case, for example, would be OHFA. You've got an underwriter, and that's the role that Mark plays. The underwriter term, what that really means is that Mark will go out into the market and find, when we put this bond issue together, he will go out into the market and find a buyer for that bond. And the reason why it's an underwriting is because in order to facilitate the process, what Mark, and I say Mark, but it's Raymond James, but what Mark will do is he will buy the bonds from the issuer, and then he'll turn around and sell it to this investor that he found. There's a lot of reasons why that is the preferred way of operating. But even if you don't have an issue, and we call that a public offering, even if you don't have a public offering, you have a private placement. So for example, let's say you've got a bank that you've done a lot of work with over the years, and that bank has certain CRA needs. That bank may be willing to allow you to structure, so and that bank was going to loan you money at, again, let's say 8%. Well, if that bank, instead of just directly loaning you that money, loans you the money by buying a bond that OHFA is going to issue, then if they have CRA needs or other needs, then they can give you a great rate. So that's another way of sort of and in that situation, it may even be a long-term bond, because those banks typically, if they decide they're going to operate in that world, they'll hold that paper for a while. So Mark still plays a role there in negotiating. I mean, what was the one deal? Progressive. Do you remember what that was? That Stearns Bank? Okay, so we did a deal earlier this year, or maybe it was last year. I can't remember. They all kind of go together. And Stearns, in a way, it was a private placement, and Stearns Bank participated. Well, Raymond James, Mark, and especially his colleague Tim Ranovic's, I mean, they played a crucial part in getting the bank, in basically being the sort of the intermediary between the bank's language and the bond language. And really, if they weren't involved, it would have been a much harder process. So whether it's an underwriter, whether it's a placement agent or something like that, you want to make sure that you've got somebody like Mark in the process, and they play a crucial role. Trustee, if your transaction, oops, I went one further. But if your transaction is not a private placement, then often a trustee will be required, and they're just the entity that takes the money from the borrower, or wherever it comes from, to pay for the project, and will turn around and pay that to all the bondholders. And you want that because you might have 50 or 60 bondholders, and the agency is not in the business of cutting a check every month to those 50 or 60 people to pay for the bond. Credit enhancer. The interest rate that you're going to pay for your bond is directly related to the safety and liquidity of that bond. And, bond transactions typically won't work with just a mortgage for a variety of reasons. An investor is buying this bond, and they want more than just a mortgage backing your promise to repay and backing their investment. So you can get a variety of credit enhancers in these transactions to enhance your bond, such that your bonds would be rated any investment grade rating, whether it's triple. I think the lowest investment grade rating is BBB-, and it goes all the way up to AAA. The rating agency is an entity. I mean, speaks for itself. They rate the bonds. The tax credit syndicator, I think most of you are familiar with those entities. They're the entities that syndicate the low-income housing tax credits in the project. Bond counsel is the role that I play. Ultimately, during the process, I will draft all of the bond documents, all of the loan documents, if you will, and the tax documents, and the closing certificates, and the opinions required to issue that bonds. Ultimately, though, what I do is I issue a bond counsel opinion. That opinion says that the bonds are enforceable, and if they're tax-exempt bonds, of course, it says the bonds are tax-exempt. The market will not buy bonds without a bond counsel opinion. You've got underwriters counsel, which is counsel for Mark. When he's working in his role as an underwriter, you have to put this document out there. Many of you probably, from your own investments, look at prospectuses. It's sort of like a prospectus. We call it an official statement. And so they kind of draft that and put it out there in the market. And I think that's sort of the bond parties, and I think Mark's going to talk about the overview of our current transactions.
You may be wondering, why these people? How did we choose these people?
we are required by the state of Oklahoma to go through a request for proposals process, an RFP process, to choose these professionals. And so they get to serve for a year from the time they do their first deal. And then we have to go out and re-RFP again. This is the team that is currently doing our deals. They're the team that has done our deals in the past. We'll be re-RFPing again early this next year. But anyhow, the state has this requirement that we have to do this. So this is how we choose these professionals.
We'll keep it real simple on this part, and that is, a lot of folks think that these bonds are financing your project. Our current structure we're doing, this 4%, we call it a cash collateralized or escrow bond structure. And you think, oh good, that means that you got a $20 million project, we issue 10 million bonds, that pays for half of the acquisition and rehab. It's not really what's going on right now. Before 2007, the financial crisis, that was true. We would issue bonds that way. We're not really doing it right now. We hope and expect that market's going to come back as interest rates go higher and the market gets a little more in sync as it was before this financial crisis. But what the current structure we're doing right now is a cash collateralized structure. You basically already have to have your deal and your financing in place. Whether construction loan or acquisition rehab loan plus the long-term financing after the project is placed in service. It might be FHA or HUD loan. It might be 221D4 senior, whatever it is. You've already got that. Could be Freddie Mac, could be Fannie Mae as your permanent financing. All that's already in place or will be. But what we're doing here is just issuing bonds for, we use the example of a $20 million project, either new construction or acquisition rehab, and we'll assume it's 18 months construction period plus or minus. What we're doing is actually, beside your project, issuing bonds in 50% of the amount of the total project cost, or $10 million in my example. Those bonds do not pay for your project. They sit there, they're collateralized by treasury bills, and every time you do a draw on your construction project, we put that money in back and forth out of that acquisition fund for those bonds. Why go through that? And it takes about a 3-month process to do those bonds from start to finish once we get going. It costs about 2.5% of the bond amount, about $250,000 on a $10 million issue. Why go through all that heartache and heartburn just to get the 4% tax credits, which could provide you plus or minus 50% or 30% of your total capital stack on that project after the tax credit, 4% tax credits get syndicated. A little bit less than half as good as the 9% tax credits. It's the beer, as Sujo said, not the champagne. But that's the current transaction we're doing right now for OHFA and have been, I guess, for the last 2.5 years. And we've done a number of them, probably 6, 7, 8 projects. They've worked well. It's been a good group to work with. We appreciate OHFA's good work and Sujo's and the entire team. But that's the transaction we're doing right now. Happy to take any comments or questions about that. But that's the current 4%, it's meeting the 50% test, and it's giving you about half of the project costs go into the bonds, and they get your 4% tax credits just to help you cover some of your equity costs in the project.
Is that the only one you want to do, or is that the only one that anyone is finding financially feasible?
The latter. We'd be happy to do, if we could be financing your $20 million project with all bonds, we'd be doing it right now, and they'd be enhanced, and all these other players would come into play. But we hope and expect that'll come back, and I don't know when that'll be, Sujo. I don't know if it's going to be a year, 2 years, whenever. Rates have got to rise. Some other things have got to happen in the market, but that's the only project we're doing, only deal we're doing right now, only because it's the one that works right now for.
So does this structure not require credit enhancement then?
Correct. Does not require any credit enhancement. Those bonds are secured by, they got T-bills, exactly. And they're AAA rated or AA rated plus, and so all good. And by the way, you might say, well, do I even care about those bonds? Do I care about their rate? Well, the answer is the rate is about 1% today. The T-bills are putting out about 80 basis points, so you'll have a little bit of negative carry, not much. But that $250,000 plus or minus is what the developer owner has to put into the project to get the bonds issued. And it's just an economic decision whether that time and expense is worth getting you the 4% tax credits. So that's the basic transaction. A couple of other items here we'll go through quickly. The typical bond documents, as Sujo mentioned, trust indenture is the main document for your bonds, covers the relationship between the issuer and the trustee. The regulatory agreement, same as you'd have for a 9% deal. It's prepared by bond counsel, meeting all the income, the low income test, et cetera, going on for the entire affordability period.
That's in addition to our regular tax credit, Laura. The regulatory agreement that's done for the bonds is done at closing, and our LURs are usually done when you're placed in service or close to being done. So it's two different documents. So, because we've had some people say, I already did a LURA, it's like, this is different, so.
Right. Typical bond documents. Next one is the official statement. As Sujo mentioned, that's just for these cash collateralized escrow bonds that we're talking about right now, although it applies to all bonds. Official statement is just like a prospectus for stock. We call it OF. First will be a preliminary official statement, POS. When the deal is final and we've got the rate set, it's the official statement, or OS. And our counsel, our underwriters counsel, prepares it. The bond purchase agreement, once again, you'll see once we get a deal going for you, you'll see all these documents. Don't worry, we've got a good team. We'll take care of all. There's a lot of moving parts to these, but generally we keep it as quick and easy and pain-free as possible for the developer. Once we get going, we'll probably have a call once a week toward the last month of the transaction, make sure we're all on track. But the bond purchase agreement is between the issuer, OHFA, our firm of Raymond James, and the owner of the project. Continuing disclosure agreement, that goes on. And by the way, these bonds, as I said, go on for, you usually have about a 24-month, 18-month term, long enough, they have to be outstanding long enough for your project to get either built or acquired, rehabbed, and placed into service. So then we put on about 6 months after that just for a fudge factor. So generally these bonds are 18 months, 24 months, 36 months. Continuing disclosure agreement goes on for the length of the bonds. It's just reporting that the trustee does for us, talking about the bonds that they're every year, that they're paying principal and interest, no downgrade, et cetera. There's some other documents there on the, once again, we'll take care of this, but if you care about it, some of the mortgage and deed of trust, credit enhancement, reimbursement agreement.
There's a lot of documents.
And here's just a diagram of the actual transaction between the borrower, you all, the developer, owner, the issuer, the bond underwriter, and then also the bondholders and the trustees toward the bottom, and the agreements between them. And on the next slide, just a diagram of this type of structure, which we're assuming most of these have been an FHA loan, 221D4, whatever it might be. We also do USDA RD loans. We've done Freddie Mac loans, all being sort of the permanent financing with a construction loan before that. But these bonds have to be in place when the project starts, right about the time when the HUD loan closes, for example. But that's giving you kind of an idea of the various parties. And as I said, these bonds only exist for you to get the 4% tax credits. As Sujo said and Pam reinforced, they're not automatic, but they do come once you issue the bonds. You get the 4% tax credits. Still has to underwrite. You want to talk any bit about that, Pam, in terms of it's not automatic, but you still got your same application you've got to.
The applications that we have received for the 4% bond apps have been less than stellar. And we think part of the reasoning is, it doesn't matter, they're going to give them to me anyway, it's non-competitive. But, we go through all of the same threshold review, we give you the preliminary reviews. Now, you do get more than one chance to fix, and we're more flexible on some of the timing and everything. But it still has to be a quality application. Your numbers have to match, you have to have your commitment letters. I mean, it's all of those threshold things from the application, and we just want to make sure that that's why, you put some time into them, the same amount of time that you would into your 9%. I mean, it's not, you're not going to lose out, we're going to work with you, but we just want to, we think that part of the thinking is, well, because it's automatic, I don't have to document my application like I would. So, that's just a request from staff, really, because some of them have been a little scary.
How would you grade them? B minus, C plus? Some of these.
I believe I will not comment on that. We just encourage, and this is for any application that you submit to it. It's 9% or 4%, but we think part of the lack of detailed attention on the 4% may be this misunderstanding that we're just going to rubber stamp it and move on. So.
Yeah, and we only get a good one. We only see the B+ and better because that's when they are kind enough to shield it. It's a good application and that we're going to talk about.
After we've already worked with them.
Exactly. Go ahead, Susie. You're going to answer.
Yeah, if I could add one thing, just so you don't think it's arbitrary, I think most of you are probably familiar with the 42M letter, which is a letter that is required from a state tax credit allocation entity in order to get an allocation of tax credits. That 42M letter basically, just in general terms, says that the agency is not allocating more credits to the project than is necessary. Well, the only way they can make that determination is if they do an underwriting on the tax credit side. And so that requirement, that 42M letter requirement, is true whether you have a 9% deal or whether you have a 4% deal. So in order to be able to issue that 42M letter, basically all of the underwriting is kind of the same on the 9% and the 4% side. And so, sometimes developers will think, well, this is automatic. I don't have to fill out these portions of it, or they don't have to be, finalized. And the answer to that is, if it's not, then the agency can't issue a 42M letter, and that's the reason for it. I just want to make sure there's understanding. It's not really an arbitrary thing. Now, maybe there's one or two provisions that some might argue is arbitrary, but I'll let you take that up with Pam.
That's well said, Sujo. And by the way, we're close to being finished here, but and feel free to ask any questions while we're going through the balance of this. Also, afterwards, we'll have a few question and answers, and Sujo and I will be around. Also, I think for lunch over at Ted's as well. So don't hesitate to let us. And you've got the contact emails, etc. It's a phone number for everybody. Go ahead, sir.
So, it's just, and I'm coming at this totally ignorant. This is my first exposure really to bonds. But is the structure that we're looking at then is 50% bond proceeds, 30% equity, and 20% conventional? Is that, am I looking at that wrong? Well, you're going to raise 30% of your equity basically.
From the 4% tax credits, right? Yeah, the fact that you issue, you got a $20 million project, you issue 10 million of these cash collateralized escrow bonds, those automatically get you the 4%, and plus or minus those 4% tax credits once they get sold, we'll give a typical developer on a typical project about 30% of its total capital cost. So it's the 4% tax credits that get you about 30% of the equity. That's right.
Leaving 20% that you have to get somewhere else.
Right. That's correct.
Plus the extra $250,000.
That's plus that. And if that doesn't make sense, then this is not the transaction, right, for the developer. It's just one that we're giving an example. Go ahead, sir.
So it's my understanding then that these bonds have to be paid back within that 2.5 to 3 year period. So we have to have some additional other financing.
Yeah.
Basically for the term aspect.
That's right. And these deals we've been doing for the last 2.5 years, generally that's been a 221D4 or a Freddie Mac loan or something else in there that you've got that's going to finance the project. The bonds, as you can see, really aren't financing this project. They're only being issued for the purpose of the tax credits.
You're not required to pay your bonds off when you close on perm and get some other financing. And you can do partial, you can pay off part of it. We've had a couple do that where they're going to pay off part of the bonds and carry the rest of it permanently. So it's not a requirement. It's just kind of the way they've been working, but you're not required to do that. If you can make it work long term, that's great. And selfishly, we prefer that because we get fees for every year it's outstanding. But it's not a requirement.
Better long-term rates out there, is what you're saying?
Yes.
That's what we've been told, is that the 221 is giving you 40 years rather than 30 or 20 in the lower interest rate. The 538s are comparable. So, that's why people are doing it, but it's not a requirement.
And then on this next slide is just some sample source and uses from a $42 million project. That third line item there you see on the sources, that's tax credit investor equity contribution. That's just an example for this was the 221D4. That's what the long-term financing was. There was a bank loan for the construction or acquisition rehab period, but that 4% low-income housing tax credits is in this example that $13 million.
Mark, on that previous slide.
Yes, sir.
The process that you had there, it looks to me like to get a construction draw funded, it starts with maybe my Freddie Mac investor and then flows through a pretty big system. What kind of logistically, what kind of delay does that mean to the project to get it completed?
No, it's none. It's same day. You do an initial $500,000 draw. Your trustee takes it, deposits an acquisition, and out comes $500,000. You're done. We might want to jump over to real quickly all the way to the costs. Oh, can I go backwards? Oh no, I'm sorry. One more. There it is. And this is giving you. This is. I'm jumping over to what slide number is that? Yeah, 43 is the sample costs of the transaction. Once again, it said it's about 2 to 3 months once we get going on these to get the bonds issued. Normally, people are timing that for the closing of the HUD loan, let's say, for example, on the 221D4. But as I said, for a $10 million deal, roughly 2.5%. And once again, paid by the developer, the owner, once again, if it makes sense, this is a nice structure. We've done a lot of it, and if it doesn't, obviously another financing. And as Pam mentioned, we would rather be doing long-term bonds for these projects and actually financing the project, but the markets aren't agreeing with it right now.
This slide be magnified when we...
Yeah, it'll be minified, but it comes out to $266,480, a little bit over 2.5% on a $10 million bond issue, which would be for and that bond issue is going to be 50% of the total project cost. So this is assuming, for example, a $20 million acquisition, rehab, or new construction. Brian?
Pre-2007, what was the longest term on the bond deal?
40 years. Usually it was 30, but we did some 40 years as well.
So each project has its own specific bond issuance you come to these deals, so you basically have to have a pretty big deal to look at justify the...
You know, we've done as little as this on the bond issue amount of $4 million, I guess, which means it was roughly an $8 million project. Now, mind you, some of the costs don't scale as well. They go down proportionally, but it's the bigger the bond issue, the more cost effective it becomes. But yeah, it can be as low as $3 or $4 million bond issuance, $6, $7, $8 million project.
Yeah, but you can combine some of your property storm. I mean, like if you had like 4 properties that you wanted to put, it'd be one application into the bond and one for the tax credit. We've had some do portfolios. Yeah, we'll have to talk about it later. But their structure's a little bit different because they can't cross-collateralize for RD purposes. So it's just a logistics thing for us. But I mean, you can still pull those together. And we had an RD deal where it wasn't structured that way, and they had 7 properties. They put into one tax credit app, one bond issuance. So, but yeah, the issuance costs are better if you have more units. And that's why sometimes combining might make sense. And also, you need to think about, if they're clustered together. I mean, it doesn't really make sense to have one in Weatherford and one in Hugo, but if they're kind of clustered around each other, you just have to consider your logistics for construction and management as well.
Do you have to have taxes and bonds to get the 4% credits, or that's just an automatic? You have to have the bonds to get the credits.
You have to have the
Correct.
bonds to get the credits. You don't have to have credits to get the bonds, but that's a totally different structure. And for that, you would use the multifamily bond app that we just created. But anything with tax credits, you would use our regular tax credit app.
And the tax credit application suffices for the bond application as well. So it's kind of one stop.
The fourth item on the agenda is other short-term and long-term multifamily structures. As I said, if we can start doing these on a bond basis, actually financing your project rather than just getting you 4% tax credits, we will. We did it before 2007. But obviously you've got 9% Transit.
Tell me where.
Whatever number 4 comes to, which other short-term and long-term multifamily structures. Yeah, we do have publicly offered bonds, not doing them currently for this structure. FHA, Ginnie Mae, that is working right now, but as Sujo said, you have to go through the process of working with HUD, and it's not easy, and it's not quick, but we do them, and that's the long-term financing for your project. USDA RD, we've done some of these as well, or at least one, since we've been doing this sort of cash collateralized 50% test bond structure, 538. And USDA, I guess a little easier than working with HUD, wouldn't you say, Sujo? But either way, it's still working through a government federal agency to do your project.
It's easier in a different way and harder in a different
way. Yeah. This really comes back into this letter of credit. This would be enhanced bonds, once again, in a situation where your bond issue really is financing your project, not in a place right now where we're doing that. Freddie Mac also has what they call a tax-exempt loan structure. We've used that before as well. That was the New Page transaction, the former Douglas High School. That was done with Freddie Mac bonds, or tax-exempt loans. The 9% tax credits we talked about are competitive. That's not a bond issue necessarily, usually is not. The 4% tax credit's not competitive, but not automatic. We'll say that for the 15th time. State tax credits, historic tax credits, and the historic tax credits can be federal or state. And we've used them all. Once again, these credits are just other little pieces of the puzzle to try to make your project work. Sample timeline, I guess that's you, Pam? Or go ahead, Daryl.
In your PowerPoint starting on page 40 is a sample timetable of a recent deal. And what that shows is that an inducement resolution was given in November of 18th, 2015. It goes through and tells you about all the different notices and drafts of documents and temporary hearings and council of bond oversight approval and all the different hoops that we have to jump through. And what you end up seeing is that on page 41 at the very end, the bond deal was closed on June the 3rd. So, you're talking fully a 6-month process.
But once we get working on the bond issue, it's only 2.5, 3 months.
Correct.
Right.
Right. But the key to that is once we get working on the bond issue, because there's a lot that leads up to it before we can actually put it together. So I know this sounds like a really long time, and it is. But the hoops are the hoops that we have to jump through. It's not because anybody's dragging their feet or anything. It's just that we have quite a few things that we have to go through.
Daryl, on that timeline, is that a simultaneous syndication closing?
Yeah.
That's right.
Yes.
Okay.
And the closing of the HUD loan also closed on,
Okay.
the HUD, on June.
HUD syndicator, it was a giant simultaneous closing.
You got it.
Right.
Syndication, the HUD loan, the bonds, everything all closed in a 2-day period. That's right.
I don't know that I need to go through any other detail on that, other than just the takeaway from that is, yes, it takes a while.
And I guess this, on the sample bond cost, this was also for you, Daryl. We've looked at it once before. We made it tiny like that so you couldn't see it. But as I said, on a $10 million bond issue, a little over 2.5%.
On one of your handouts there, you'll see that we have a sheet that talks about the fees for a typical $10 million bond issue. And really, it's divided into 3 categories. It's the fees that are due to OHFA for processing all of our paperwork. Then secondly, there are the fees that are due to the bond professionals. And those fees are not negotiable because we had to, when the professionals bid on the work and we chose them, they bid on the fees and we accepted those. So that's not something that you get to come in and say, hey, can you take $10,000 less? No, the fees are what they are.
But those were, in most instances, they're scalable.
Oh, yeah, they're scalable. Yeah, correct. Yeah, it depends on the size of the deal.
And once again, this is based on a $10 million deal. And then finally, you've got your standard tax credit fees that are due to the agency. So anyhow, as you can see, OHFA fees on a $10 million deal, $112,500. If your bonds stay out there till year 6, then beyond year 6, you would pay a $25,000 annual compliance or administrative compliance fee.
Is that why they don't financially work out?
No,
Are you asking that?
No.
25 grand a year?
Yeah, I thought you weren't looking at me at first.
25 grand a year?
Well, but that,
How many years was that property?
remember, these bonds are being paid off usually within a year or whatever, so
That's
they're
on
not,
the bound.
so they're not staying out.
But if we were to go back to the structure that you were talking about, let's say we do a private placement, you know.
And did 30-year bonds? Yeah, did 30-year bonds or 15-year affordable?
If you were to leave them there, yes, that would be payable. Right.
It's on outstanding balance.
Yeah, on the outstanding balance, there'd be a decreasing amount as time goes on.
Oh, so it's not a flat 25 grand, it's a
It's
No,
percentage based.
it's 25 basis points
25 basis points of the outstanding bond.
on the outstanding bonds.
And this assumed a $10 million bond issue again.
The bond professionals, yeah, didn't mean to give you heart failure plans. The total for the bond professionals is $150,400 plus $2,000 annually, and then the tax credits, there's going to be a varying amount of tax credits that are going to go to each project, so it's hard to give you a general number based upon the $10 million deal, but you can see those numbers there. So anyhow, that's just a general rundown of what the fees are that would be due payable. Now, what you obviously need to do is compare that to what, if you're going to just get a bank loan, if your lender is going to charge you an origination fee or whatever, and you would need to compare these fees with what the bank would charge you. The one thing about it is, without the bonds, though, you don't get 4% credits, and so, the 4% credits have some intrinsic value there, so, to compare apples to apples is a little bit difficult. But anyhow, at least this can give you some kind of an idea of what the costs are that you would incur.
I wanted to talk just a minute about the pre-app inducement that we're doing. This was based on advice from Sujo about getting you that inducement resolution earlier on and deposit on the inducement fee, like a brief resume, like 1-2 pages, a description of your property, like how many units, where it's going to be, single family, multifamily. We know there are estimates, but just to give the board an idea of kind of what kind of property it's going to be. And then just like a 1-page sources and uses, kind of how you plan on structuring the deal. And then we'll take it to the board, we'll give you the inducement resolution, and the inducement fee is due like 2 weeks after that board though, so just let you know, but it'll be a cost probably, but that came as a surprise to some people. But so that's kind of the process, and then you and your partners can go forward and work on the details and putting together your application, and then you can come in later with your application for your 4% and your bonds, but you've already been able to accumulate all these costs that Sujo was talking about. So that's kind of our process, and that's been in the last year or so. So when you're filling out the tax credit application, it's everything but the selection. You don't have to do selection because you're not competitive. There's no limit on the tax credit request, so knock yourself out. Just remember that your bonds have to be, half of your costs. Right. The only deadlines we have is that if you get it in by August 1, we say that we'll consider it in the current year. If you get it after August 1, we'll still consider it, maybe not that current year. So if you're worried about some December deadlines, you need to apply earlier in the year probably. Otherwise, it's just a rolling deadline, which works out better for you and us. But we require at least 60 days before we take it to the board. Now, if it's pristine shape, like you're going to do, like pay attention, then, maybe we can go a little sooner. But we're saying minimum of 60 days. So when you're looking at your timing of things, we don't want you to submit an app and think that in 2 weeks we're going to take it to the board and you're going to close in another month, because that's not happening.
Everyone, I guess, in the room know that your board meets about third Wednesday at 10 a.m. in this room about every other month, so starting in January. So.
Most do, but yeah, that's a good point. Thank you. So yeah, January, March, May, July, September, November is when the board meets. The bond deals, the 4% deals, can only get the qualified boost if you're in a QCT or DDA. The bond deals are not eligible for the general 120% state boost that we have. So just be aware of that. We created an exception for, we have our new to Oklahoma rule that you have to have one deal all the way done. And we created 3 exceptions for 2017. And one of them is specifically related to bond deals, that if you get one bond deal closed, that you've gone through all the app process and you've closed on your bonds and everything, you can go ahead and submit a second one and still meet your new to Oklahoma requirement. And then, but we're not going to accept a third app until you get one of them done. So that because they take longer, we felt like we could give that exception. And once you get to closing, I wouldn't say the rest is easy, but it's the stuff that's very familiar. It's the construction, it's the actual building of the properties, and then leasing. So I just wanted to point that out. And we already said about if it's only multifamily bonds, you can use that new app. But if that's what you're thinking about doing, then probably you need to talk with us, and so we can talk with Mark and Sujo, because that'll be something different. So the current app, the 2017 app, is online. If you get it in before the end of the year, you can use 2016, and all of those requirements apply. But if it's submitted after, if it's January 1 or later, it should be 2017. So be sure to read the current app, because we made changes and you just need to be up to date. And then the application form, we'll probably cover this. We are going to cover it more this afternoon, but it's going to be kind of a ongoing update. I'll be making some formatting changes and other documents, so it's not any substantive, but whenever you get ready to do your actual application form, just go online and pick up the most current one, and they'll have all the latest formatting changes. So and then I already mentioned about the 1.5 already. We exceed that. And the PowerPoints and video will be on the website, and so you can make the slides full size so you can read them. Hopefully this week. And then just point out that we have multifamily bond rules that govern the program too. So that's all. Oh, okay.
So the state bond cap for the state tax credit for 2016 has already been committed.
No, because these 4% with state tax credits are for 2017 credits. And we said we would count the earlier of the inducement or the actual application received. And we passed one inducement with state credits at the September board, and we have 2 on board for November.
So rolling forward, will you create a line
Well, we can't commit 18 till 18, but, well, I mean, that's,
Almost at this point, there is a limit, but we're not going to hit the state credit. Yeah.
on the state credits, though.
Oh, sorry.
Well, I mean, that's why the third person got in line. He knew he didn't have enough, there wasn't enough going to be to fund his deal, but he said, I want to be next in line in case number 1 and 2 don't succeed, or for some other reason we increase the amount. So going into 2018, I don't know we don't know yet.
Pam, you said, maybe I misunderstood, if you turn the application in prior to December 31st, you want us to turn it in under the 2016 application, and if we turn it past December 31st, you want us to turn it in 2017?
I mean, you could use 2017.
Okay, but I can also use 2016 if we get it turned in before December 31st.
Right, some people are concerned about some of the changes, like the 20 to 30,000 rehab,
Sure.
and they
Yeah,
want to,
legitimate change, yeah.
right, and they want to get it in this year, but, you
Even
know,
though you know you're not going to allocate until 2017. If we get it turned in on time, we get 2017 allocation off the
Right.
2016.
it also affects your QCTs, because if it's in before December 31st, you use 2016 QCTs. If it's after January 1, you got to use 2017, which we don't have the list yet.
So I wanted to go back and just sort of put all of this in context. And I thought of a different way because, you know, I realize that sometimes it makes perfect sense to us up here, but I'm looking out there and I see some question marks in some eyes. And, you know, I'm like, well, how come they don't understand this? And I sit down and I think about what I said. And so let's back up. Right now, let's forget about bonds and tax credits. If you had a $10 million transaction, it was going to cost you $10 million to acquire and rehab the facility to your standards, to PCNA standards, all right? And you need to find a source of funding for that. So you would go to your bank, let's just assume. And that bank is going to say, okay, fine, I'll give you $8 million, right? 80%, let's say. So in order to close that transaction, and the bank has their origination fee, and the bank has their counsel's fees. You have your counsel's fees. So you put all of that together, and let's say if that total cost comes to $11 million. The bank is going to give you 80%, let's just assume it's 80% LTV, they're going to give you $8 million. So you're going to come to the table, to close that transaction, you got to come to the table with $3 million. And fine, if you can do that and the numbers pencil out for you, that's great. You know, taking into consideration what your project revenues are going to be, assuming that the project revenues hit a certain standard to make, you know, pay your debt as well as to pay yourself. And so you get your transaction to work. And that structure in the old days worked even with bonds. You went in and you said, well, instead of borrowing from the bank, and remember, your bank borrowing is two parts. If it's an acquisition, rehab, or new construction, there's a construction portion of it, and then there's a permanent portion of it. So it was just all in one thing. And that worked in the early days with bonds. You had a transaction, your total cost, you know, again, same things, $10 million. And you said, well, if I use a bond issue, I can get 90% LTV, you know? And so, and that bond issue had certain costs that was associated with it. And let's assume that was another $1 million, so it's an $11 million transaction.
And the bond might be at a 5% interest instead of 8 for the bank or whatever.
And the bond might be at a 5% interest instead of an 8% interest.
In the old days.
In the old days. So again, you're closing your bond issue, you're coming to the table with $2 million now, $1 million less, because for a bond issue it was 90% LTV. Let's assume that, you know, we also do some other kind of crazy stuff. You know, banks typically might lend at the most for 30 years. We might be able to go 35 years or 40 years, or we might be able to do 30 years with a 40-year amortization schedule, all right? So basically, you've got a lot, I mean, your cash flow is the same, your revenues are the same, but all of a sudden your debt load has become less, at least on a monthly or annual basis, right? And so, and that's because of the lower interest rate and also because maybe a longer amortization period. So now you've got more money that, you know, can fund your developer fee or other, you know, in your pocket, let's just say. which we all know that you're an affordable housing developer, so once it goes in your pocket, it comes back out for the next affordable housing transaction. All right. So then the next iteration was tax credits. All right. Now what happens is, let's assume those same things, $10 million transaction. You've got $1 million of cost to do your bond issue, but now you got tax credits. So let's bump that up to $1,250,000 because the tax credit investor is going to have some costs, right? But basically, all of that equity that you would otherwise have to come to the table with now is not coming out of your pocket. So you got $2 million, or maybe in this case, $2.25 million of equity that came in to make the deal work from your tax credit investor, and what you paid for it is an extra $250,000. So if I could go back, and can we go to slide number 29? Okay, let's assume this was the old style long-term bond issue. So again, your bond issue is paying both your construction and your perm, and it's a long-term rate, all right? If you looked at this sources and uses, and if the numbers worked out, you've got a total project cost of $42 million. You're structuring a bond issue, so you've got an extra, let's assume that the cost schedule that was further back was based on a $10 million deal. This is going to be well, the bond issue, though, was probably going to be closer to maybe 30 or so because you got equity coming in. So let's just assume that and remember, those bond costs are scalable. So the larger your project, obviously, the less percentage it is. So let's assume it's $350,000. Okay, for that extra investment, you're generating $13 million of equity. That's what your tax credit investor has agreed to pay you to come into the transaction. All right? So, and I realize I'm talking generalities, but I think that that's just kind of best way to layer these in. So, starting in 2006, we were in an interest rate environment where it didn't make any sense for you to do long-term bonds. Your long-term bonds might be an interest rate of 6%, but you could go borrow from a bank for an FHA-insured mortgage loan at 5%. Why would you do bonds? You're paying an extra percent a year on interest over an FHA-insured mortgage loan. And the answer is...
And probably higher cost, too.
And maybe higher cost. The answer is you wouldn't do that. And that's basically what happened. In 2006, boom, I went from doing, maybe $200 million worth of bond projects a year before to literally zero in 2006. But if you're not doing bonds, you can't get that $13 million of tax credit equity. So you're back to the scenario where you're going to the bank and you're borrowing money, and the difference between what the bank's going to give you and what your needs are comes out of your pocket. So this is when we created this short-term, I don't like to use the word escrow, cash collateral structure. Basically, you're doing two borrowings, all right? You're going to go out and you're going to find a lender who is going to, let's assume it's an FHA-insured mortgage loan. So let's say it's Oppenheimer, because they came in on one of these deals. Oppenheimer is going to make you a long-term mortgage loan that's FHA-insured. And that rate, let's say, is going to be 5%. And it's going to be for your whole project cost, okay? And they're going to require, because it's, you're back to the borrowing from a bank, that there's a certain amount of money that you're going to have to come to the table with, all right? So what we said is, well, we know that the federal government says in order for you to access tax credits, you have to have bonds. But what the rules are is those bonds only have to be outstanding generally until the placed in service state of the property. So they don't have to be outstanding for the long term. So basically what you've got going on is you're getting your mortgage loan and you're closing on that mortgage loan. And I'm not going to, I can talk individually if you want about how this works. But basically, let's assume that your placed in service date is 3 years later. In essence, what you've done is you've taken out a long-term loan with Oppenheimer for, in this scenario, let's say it's just $30 million, at 5%, okay? But for 3 years, you've taken out an extra loan for half of that amount, let's say $15 million, from OHFA. And that half, that year, those 3 years, the interest rate on that loan is 1%. So for 3 years, you've got a long-term loan at 5% and a short-term loan at 1%. Why does that make sense? Because for the cost of doing that transaction, which is let's assume it's $350,000, and for the negative arbitrage, in this case it's $48,000. Let's just round it up to $50,000. So that's $400,000 of extra costs that you're going to have for that 3-year period. You've generated $13 million of equity, and that's why the short-term structure works. Basically, the end of that bond structure, in essence, that FHA loan proceeds that you got from Oppenheimer pays off the bonds, and all of your project costs now are paid for. There are so that's the basic structure that we've used since 2006. There are 3 long-term structures that work. One is we've done with Oklahoma Housing, which is Freddie Mac has this program called a TEL that Mark alluded to. It's called a tax-exempt loan. It's a bond issue, but basically the developers tell us that their terms are attractive. And you'll have to look at the terms for yourself and see if you find them attractive or not. Keeping in mind, Freddie Mac's the 800-pound gorilla. They get what they want. But it's work. I mean, and we've done many deals under the Freddie Mac TEL structure. The second long-term structure that works, in other words, again, these are the long-term structures where you don't have this sort of two loan structure. The other ones that work are Redstone. We've seen many deals with Redstone where they come in and buy the bonds, and often they'll buy the tax credit equity as well. So Redstone, you can go out and Google that, and you'll see the underwriting terms. And the third type of long-term structure that works is if you've got a friendly bank, a private placement. If you've got a bank that you've done a lot of work with, and they're willing to give you a long-term rate long-term loan at an attractive rate, we can turn that into a bond issue. So you got 3 long-term structures that work in today's market. Other than that, if you want to use anything else, you use this short-term cash collateral structure. The example I gave for the short-term cash collateral structure is an FHA insured mortgage loan. It doesn't really matter what that long-term loan is. It can be a loan from your brother-in-law. You know, whatever that long-term structure is, it can be anything. There are no requirements on it. The only requirement that we have is if you want to, if you're doing the short-term structures, that the bonds have to be outstanding until the placed in service date.
And minimum 50% of the total project.
And at a minimum, in order to get the tax credits, 50% of your project costs have to be financed with bond proceeds. And that's why if your long-term mortgage loan is $30 million, at a minimum, we would issue maybe $15 million. So that's that kind of overview. I don't know if that helps or not, but yes, sir.
Hopefully doing an executive 542 risk share with HUD, and if so, what level of a risk share lender are you?
The answer is no. No, we're not doing any risk share. We've looked at it. We continue to look at it. For us, we didn't, we honed in on that word risk, okay? And we didn't think that for us at this time it made sense. But that doesn't mean that it might not make sense in the future for us. Okay, we've got time for maybe one more question before we adjourn.
Nonprofit, you didn't mention.
All right. So if you're a nonprofit issuer or nonprofit entity and you want to issue bonds for your particular project, then some of the rules that I mentioned you don't have to comply with. Now, you're not going to get tax credits because the owner of the project has to be a for-profit entity, right? Because otherwise, tax credits would be useless to that entity. A nonprofit can come in as a GP in a for-profit transaction and participate that way. But if you're looking at a pure nonprofit transaction, then you are, there are certain rules that you don't have to comply with. The set-aside rules for by and large don't matter because you're meeting your mission. That's the reason why you got your C3 status, and so presumably all of your units are affordable. The rehab requirements are not applicable to nonprofits. And there's many different ways where nonprofits will participate. We've worked with a large nonprofit that basically bought a lot of properties around the United States. And their MO was buying Section 8 properties. So they bought a lot of Section 8 properties. They didn't have to put any rehab into them. But what they're doing is when they get a reasonable number under their belt, they're now going to flip them and securitize them. They will maintain, they will stay in the transaction as the general partner, but then they're going to syndicate out all the interest, and that's when the rehab requirements would be applicable. And S&P has a program, where I said for most purposes, investors don't like or won't buy just mortgage bonds in a public offering. S&P does have a program that's geared towards nonprofits. And that program, once you meet their criteria, they will give you an investment grade rating. So that is one of the exceptions where you can get an investment grade rating for a bond issue that is backed only by a mortgage.
I hope that everybody's learned a little bit of something today. This was not intended to be an exhaustive treatment of the subject. It was really meant just to kind of whet your appetite, give you a broad overview. Want to let you know that we at OHFA are available to consult with you, answer any kind of questions that you have about this. Our bond professionals are available as well and would love to visit with you. I do take note that there are a couple of apartment brokers in the audience, and I would encourage you to share this information with purchasers and owners that you're working with to the extent that you don't already. It is a financing structure that can work very well. And there are a lot of tenants in these apartments that you all work that already meet the income criteria of this program. And so it's a financing structure that could be beneficial for you.